The investment profile of Meren Energy has been fundamentally reconstituted over the fiscal periods of 2024 and 2025. This metamorphosis was catalyzed by the strategic decision to consolidate its 100% ownership in Prime Oil and Gas Cooperative, a move that effectively doubled the company's reserves and production base. By absorbing the 50% interest previously held by BTG Pactual in the Prime joint venture, Meren Energy has emerged as a streamlined, high-netback, full-cycle independent exploration and production E&P player. Meren Energy occupies a unique niche. It possesses a portfolio anchored by low-cost deepwater production in Nigeria, while simultaneously holding high-impact exploration and development exposure in the Orange Basin offshore Namibia and South Africa. The transition into 2026 brings a complex set of variables, including a guided production decline and significant non-cash impairments that have tested investor sentiment.
The bear case: operational gaps and structural headwinds. The most prominent bearish argument centers on the projected production decline for 2026. Management's guidance for the year anticipates a working interest production of 23.0 to 28.0 kboe/d, a significant drop from the 30.8 kboe/d achieved in 2025. Entitlement production is similarly expected to fall to 28.0 to 33.0 kboe/d from the 35.1 kboe/d reported in 2025. This decline is largely a consequence of the drilling holiday observed in 2025. In order to interpret newly acquired 4D seismic data and optimize future well locations, infill drilling was paused across the Akpo, Agena, and Agbami fields. While this strategy is technically sound for long-term recovery maximization, it leaves a production vacuum in 2026 as natural field declines go unmitigated by new well completions. Skeptics argue that this gap creates earnings volatility and reduces the company's free cash flow buffer during a period when oil prices are forecasted to be softer. The EIA, for example, expects Brent crude to average $55 to $58 per barrel in 2026, down from approximately $69 per barrel in 2025. Another point of concern for bear-leaning analysts is the sharp decline in the net present value of Meren's reserves. The year-end 2025 reserves determination delivered an after-tax 2P NPV valuation of $1,499 million, representing a substantial decrease from the $2,128 million valuation at the end of 2024. Similarly, the 1P NPV fell from $1,248 million to $588 million over the same period.
This downward revision was driven by several factors, including the production of barrels throughout the year, technical revisions, and a non-cash impairment of $105.3 million for the Agbami field. Management attributed the Agbami impairment to a more conservative oil price and cost outlook compared to prior assumptions. While non-cash in nature, such impairments highlight the sensitivity of Meren's core assets to macro variables and the ongoing pressure to replace produced reserves through successful exploration and development. Although aggregate working interest 2P reserves plus 2C contingent resources increased slightly to 140.2 mmboe, the bear case posits that the conversion of these contingent resources into proven reserves is far from guaranteed and will require significant future capital expenditure. Meren Energy's heavy operational concentration in Nigeria remains a central pillar of the bear case. Despite the regulatory improvements offered by the PIA, Nigeria is consistently ranked as a high-risk jurisdiction for international energy operators. Issues ranging from security concerns in the Niger Delta to fiscal volatility and the potential for regulatory disputes can disrupt operations and impact cash flow. The company's experience in late 2025 serves as a cautionary tale. EBITDAX for the year was near the lower end of guidance, partly due to larger overlift adjustments and variations in Nigerian royalties and levies. Furthermore, while the revised gas pricing agreement is a positive development, its successful implementation depends on the liquidity of the Nigerian power sector and the continued commitment of state institutions, like the NNPC, to market-driven reforms. For investors seeking stable, low-risk exposure, the Nigeria discount applied to Meren's valuation may be seen as a permanent feature rather than a temporary anomaly.
Regulatory and ESG pressures, the impact of Bill C-59. As a Canadian-domiciled company, Meren Energy is navigating an increasingly complex regulatory landscape regarding environmental, social, and governance, or ESG, reporting. In June 2024, the passage of Bill C-59 introduced significant amendments to Canada's Competition Act. These new provisions impose a reverse onus on companies, requiring them to substantiate any environmental performance claims with adequate and proper testing using internationally recognized methodologies. The implications for Meren are significant. If the company's climate targets or sustainability disclosures are deemed unsubstantiated, it could face monetary penalties of up to $10 million. A final point of skepticism for the bear case is the sustainability of Meren's high dividend yield. In 2025, the company reported a net loss of $31.6 million, or 0.05 cents per share. While the loss was primarily driven by the Agbami impairment, it highlights the fact that the dividend is currently not covered by GAAP earnings. The company's payout ratio for 2025 was technically negative, meaning it was paying a dividend while reporting a net loss. Although cash flow from operations, $261.8 million, was sufficient to fund both capital investments, $100.2 million, and dividends, $108 million in 2025, the projected decline in CFO to a range of $185 to $255 million in 2026 leaves less room for error. If Brent prices were to dip significantly below the $60 to $70 per barrel range, or if operational costs were to rise unexpectedly, the company might be forced to choose between its capital investment in growth projects like Akpo Far East and maintaining its dividend at current levels.
The bull case: deep value and high-impact catalysts. The cornerstone of the bullish investment thesis for Meren Energy remains its exposure to Nigeria's premier deepwater assets. Through its consolidation of Prime, the company holds significant working interests in the Agbami, Akpo, and Egina fields. These fields are operated by industry majors Chevron and Total Energies, which provides Meren with the benefit of world-class operational expertise and infrastructure. The technical stability of these assets is evidenced by their low operating costs, which remained in the low teens per barrel of oil equivalent throughout 2025. The recent performance of these fields underscores their value. In 2025, Meren achieved a working interest production of 30,800 BOEPD and an entitlement production of 35,100 BOEPD. This level of output generated an EBITDAX of $440.7 million and a cash flow from operations of $261.8 million. The Nigerian assets are characterized by high-quality light and medium oil, which often commands a premium or realizes prices higher than the dated Brent average. In the fourth quarter of 2025 alone, Meren realized an average price of $64.4 per barrel, outperforming the benchmark during a period of volatility. The technical longevity of these fields is being actively managed through sophisticated subsea tiebacks and infill drilling. The Akpo West project, for example, successfully added condensate production in 2024, demonstrating the low-risk, short investment cycle strategy that management prioritizes. Moving into late 2026 and 2027, the company plans to recommence drilling campaigns at Akpo, Egina, and Agbami, leveraging 4D seismic survey results to optimize well placement and arrest natural declines.
The gas pricing reset, an underestimated revenue stream. A critical but often overlooked bullish catalyst is the fundamental reset in Nigerian domestic and export gas pricing. In early 2026, Meren reported an amendment to its gas sales agreement that introduces a pricing index more closely aligned with international LNG economics. This amendment is not merely a forward-looking adjustment, it includes a mechanism to recover historical pricing differences dating back to 2020, potentially resulting in a significant lump sum payment in the first half of 2026. The broader Nigerian policy environment supports this shift. Under the Petroleum Industry Act and the Decade of Gas initiative, the Nigerian National Petroleum Company Limited, NNPC, is pushing for market-driven pricing models to replace administratively determined prices that have historically led to arrears and discouraged investment. Meren's CFO, Aulel Parasini, has suggested that these changes could potentially double the company's gas revenues compared to the level seen over the last 3 years. As Nigeria targets a ramp-up in gas commercialization from 60% to 75% by 2027, Meren stands as a direct beneficiary of increased liquidity and improved contract enforcement in the domestic gas market. Exploration upside: the Orange Basin and the Venus discovery. while Nigeria provides the cash flow. The Orange Basin offshore Namibia and South Africa provides the high-impact growth potential that captivates institutional investors. Meren holds a leading carried position in this basin through its 39.5% interest in Impact Oil and Gas. The primary focus of this interest is the Venus light oil project in Block 2913B, widely considered one of the most significant deepwater discoveries of the decade.
The bullish narrative for Venus is reinforced by the involvement of world-class partners. Total Energies, acting as operator, along with Qatar Energy and Gulp, are progressing the project toward a potential final investment decision, FID, in 2026. First oil is targeted for the 2029-2030 window. The scale of the Venus discovery, combined with recent successes at the nearby Mopani field, Gulp, has transformed Namibia into a global exploration hotspot. Meren's position is particularly attractive because it is largely carried through the appraisal and development phases, minimizing its capital exposure while maximizing its potential for reserve replacement and NAV growth. Furthermore, Meren holds a direct 18% non-operated interest in Block 3B/4B offshore South Africa. This block is situated in the same geological trend as the Namibian discoveries, offering additional look-alike potential. In Equatorial Guinea, Meren operates blocks EG-18 and EG-31, where it has recently secured license extensions and is seeking farm-in partners to support drilling activity in 2026 or 2027. This multi-basin, multi-jurisdiction exploration portfolio provides the company with a pipeline of high-margin opportunities that complement its producing core. Financial resilience and capital allocation discipline. Meren Energy's financial framework is built upon three pillars: balance sheet strength, organic growth investment, and shareholder returns. Throughout 2025, the company demonstrated an exceptional commitment to deleveraging, reducing its reserve-based lending (RBL) facility by $420 million. This reduction not only lowered interest expenses, but also improved the company's net debt to EBITDAX ratio to 0.4x as of year-end 2025.
This financial discipline has enabled a robust shareholder return program. In 2025, Meren distributed approximately $100 million in base dividends and repurchased $8 million in shares. For 2026, the company has announced a quarterly dividend policy that targets a significant yield for investors. The first quarterly dividend of 2026, amounting to $25 million, has already been declared. With a dividend yield that has fluctuated between 8.79% and 10.32%, depending on the share price and exchange rate, Meren is increasingly viewed as a top-tier income play within the small-cap E&P sector. The bullish case is further bolstered by the current market valuation. Meren Energy trades at a PS ratio of 1.8x, which is a substantial discount to the peer average of 3.8x and the industry average of 3.1x. Deep dive analysis, the 2026 strategic inflection point, management transition, technical leadership for a development phase. The appointment of Dr. Oliver Quinn as CEO on February 2, 2026, marks a pivotal shift in Meren Energy's corporate lifecycle. Dr. Quinn, who previously served as the company's chief commercial and operating officer, brings a technical background as a geologist, PhD from the University of Edinburgh, and extensive executive experience at Cosmos Energy, Hess Corporation, and Shell. This transition is viewed as a natural evolution following the deal-heavy tenure of Roger Tucker, who oversaw the transformational Prime consolidation. Dr. Quinn's leadership is expected to prioritize operational execution and the maturation of the exploration portfolio. His deep understanding of the geology in the Orange Basin and the technical complexities of deepwater Nigeria is seen by the board and the African Energy Chamber as ideally suited for the upcoming drilling and development campaigns. The orderly nature of this handover suggests strong corporate governance and a unified vision for the 2026-2020 growth strategy.
To understand the 2026 production trajectory, one must examine the specific activity at the three core Nigerian fields. Akpo and Egina, Total Energies operated. These fields are the primary engines of Meren's production. In 2025, they were the subject of an optimization exercise following the pause in infill drilling. For 2026, the focus is on the Akpo Far East prospect, a tieback opportunity located approximately 5 kilometers from the main Akpo field. This prospect holds a best estimate gross prospective resource of 143.6 MMBOE of light oil and high GOR gas. success at Akbo Far East could provide a rapid, high-margin production boost to offset natural declines. Agbami, Chevron operated. Agbami has been a steady performer, but was the site of the $105 million impairment in 2025. Current activities include life extension studies for the FPSO and contracting for a rig to begin a new infill drilling campaign in early 2027. The Ikija appraisal well is also being matured to potentially join the Agbami drilling queue. The economic interest versus working interest dynamic. An essential nuance in the Meren energy thesis is the distinction between working interest, WI, and entitlement production. Working interest represents the company's share of project volumes based on its ownership percentage in the license. Entitlement production, however, is calculated using the economic interest methodology, which includes cost recovery oil, royalty oil, and profit oil.
In 2025, Meren's entitlement production, 35,100 BOEPD, was higher than its working interest production, 30,800 BOEPD. This dynamic is typical of mature production-sharing contracts in high oil price environments, where the operator may receive a larger share of barrels to recover costs. For 2026, the guidance suggests this gap will persist, which provides a measure of downside protection for Meren's cash flow even as the aggregate field production declines. Equity valuation. When comparing Meren to its Africa-focused E&P peers, the company stands out for its high shareholder yield, dividends plus buybacks, of approximately 10%. Its EV to EBITDA multiple of 3.1 to 3.9x is competitive, especially given its low net debt position. However, its price to LTM sales ratio of 1.76 to 1.9x is lower than the industry average, reflecting the market's ongoing caution regarding the Nigerian production profile. Conclusion. The transition to 100% control of Prime's assets in 2025 has created a more powerful and efficient vehicle for capturing the value of Nigeria's deepwater production. The company's successful deleveraging, reducing its RBL by $420 million, has significantly de-risked the balance sheet and provided the financial flexibility to fund both a peer-leading dividend and high-impact exploration in Namibia.
The bull case is anchored by direct control and cash flow. The Prime consolidation provides direct access to high-margin Nigerian production and the ability to optimize capital allocation across the portfolio. Namibian optionality. The Venus discovery offers world-class growth potential that is largely carried by majors like Total Energies. Income and value. A 9+% dividend yield and a significant discount to DCF fair value provide a compelling total return proposition for value-oriented investors. Gas catalyst. The revised Nigerian gas pricing index could double gas revenues and provide a lump sum cash infusion in 2026. The bear case is defined by production lull. The guided decline for 2026 production due to the 2025 drilling pause creates a year of operational headwind. Jurisdictional risk. Nigeria remains a complex environment where fiscal volatility and non-cash impairments like the $105 million at Agbami can weigh on sentiment. Regulatory hurdles. Canadian Bill C-59 and global ESG standards impose new compliance costs and litigation risks on international energy players. Dividend coverage. A reported net loss in 2025 means the current dividend is paid from cash flow rather than GAAP earnings, reducing the margin of safety if commodity prices weaken significantly.